Hello, my name is Denny Benson and welcome to Covered Call Corner. This is the first of 3 tutorials of an investment strategy I use with my own personal investments. This tutorial will get you started on doing covered calls and understanding the basic concepts. It will give you an idea of what the risk rewards are by using this strategy, and I give you some of the reason why I use it, but I also highlight some of the disadvantages of possibly using this strategy as well. This is in conjunction with weekly presentations that I want to make on this channel related to individual covered call positions that I'm interested in, that I'm investing in, or that I've had in the past, and I will share what my intentions are and what my results are as well. Let me make this caveat up front. It's right here on the cover slide. These are my opinions and should not be taken as investment advice. Consult your investment advisor before making any investment. These transactions do have downside risk. So without further ado, let's move on. What is a covered call? A covered call is when you own 100 shares of a particular stock or security like an ETF, and you write a call contract against it. It's covered because you own the underlying stock, so that if the price of stock goes up and you have to relinquish shares of the stock, you already own it. So that's why it's covered. You already own the stock and the call itself, so that's why it's covered. All right. We're going to talk about, to further understand this concept, we're going to talk about 4 basic ideas, some options basics, what are puts and calls. We're going to look at chains, how to read them and how to figure out those calculations when trying to find what your maximum profit could be with covered calls. We're going to discuss briefly how to find the premium, which is the difference between the current stock price and what the call is worth. And then finally, we'll finish up with some advantages and disadvantages of this strategy. So let's start with some option basics. There are 2 types of options. There are calls and puts. The call option, well, first of all, with option contracts, they're just that, they're contracts. So if you buy a call contract, if you're purchasing the right to buy 100 shares of that stock at the strike price or agreed price by a certain date, that certain date is known as expiration. Now, put options are the exact opposite. You buy the right to sell 100 shares of that stock or ETF at the strike price by the expiration date. Now, those are the 2 definitions. We're going to stay laser focused on call options. So again, the buyer of a call option will have the right to buy 100 shares of that stock at the strike price by the expiration date. So we'll get into an example with General Motors, GM, here in just a few minutes, and I think it will come clearer into perspective. Now remember, somebody is buying the call option. I'm proposing that we are the seller of the call option. So there's 2 sides to every transaction, and here we're going to talk about selling these calls, and they're covered because we own the underlying stock. So then there's expiration day. So this is when these contracts are either exercised or evaporate. If they're exercised, a transaction occurs. That means the buyer of the call option will then now own the stock by paying the strike price for the stock. The seller of the covered call will lose possession of those 100 shares of stock on this transaction. So at the strike price or above, the stock is sold at the strike price. If it's below the strike price, the owner of the covered call will continue holding the security. And the reason for that is that if the strike price for GM was $52, but the stock was only selling for $51.33, then the owner of the call contract would let it evaporate, meaning that he would not exercise it by buying the stock at 52 when he can buy it on the open market for $51.33 per share. So this comes way more into clarity when you see some of the charts and tables that I show you in the next few slides. Finally, there's a third option on expiration day. You can roll the call, which means you buy to close the call position. So you're buying to close the call, and then you're selling to open a new call, probably for the next week or the next month, possibly at the same strike price, maybe at a new strike price. But all of that information about rolling calls will be covered in tutorial number 2. All right, so let's look at some option chains. I picked General Motors as an example. All right, you need 4 things when you're looking at options tables when you're doing covered calls. First of all, you need the stock and the stock symbol. Here the company is General Motors, and the underlying symbol listed on New York Stock Exchange is GM. So that's known as the ticker symbol for General Motors. The second thing you need to know is whether you'll be looking at calls or puts. And since we're doing covered call corner, we're going to be laser focused on calls. So the put side of the equation we're really not too concerned with. The third thing you need is the expiration date. So this was recorded on February 28th, 2021, a Sunday. I'm looking at the calls on Friday. I actually pulled this screenshot yesterday on Saturday, so it was 6 days hence. So the price of stock on the Friday close for General Motors was $51.33 at the 4 p.m. Eastern time close of the New York Stock Exchange. Notice in after hours trading, it slid down a little bit. The bid and ask was between $51.11 and $51.31. But for example purposes, we're going to use the price of GM as $51.33 when we do our calculations here. All right. So I've talked about the stock and the stock symbol. We talked about calls. We talked about expiration. The fourth element you need is a strike price. What price are you willing to give up the 100 shares of GM at? So if you bought it at $51.33, you might go, well, I will only want to sell it at a profit, $51.50 and higher. But I'll show you how you can make profits even if you sell the 50 call or the 51 call. Notice this shading, and this is a screenshot from my personal Schwab account. And I highly recommend Schwab, and I'll get it more into that near the conclusion of this presentation. But the shaded light blue for the calls, these are known in the money contracts, and the white ones are known as out of the money. In the money means that these options would probably be exercised if the stock remained at this price. Okay, so yes, if I had the opportunity to buy GM at $51 when in the open market it was $51.33, yes, I would buy that option. I would buy that stock at expiration. Here, $51.50, if my strike price was $51.50 or $52, since the open market is lower, I would let these options evaporate. So we'll take a look at this in some tables coming up ahead. So this is what an option chain is. Remember, there are 4 elements that you need to look at. One is the stock, usually searched by the ticker symbol, here GM. You're looking at the calls, not the puts. You're looking at an expiration date, and I'm going on the weekly calls, which expire the last business day of the week, typically Fridays. And then we need a strike price, which is this column here. So having looked at an options chart, let's take a look at calculating the maximum profit. So I've looked at the different call options. The previous screen had $49.50 through $53. This chart shows you from $50 to $53. As we argued, the purchase price of the security was $51.33 per share. I'm buying 100 shares. And since I'm using Schwab, using an online order, my purchase fees are zero. This is some of the beauty of zero commissions, which have become quite the rage here in the last year. All right. So my total purchase price is 100 times 51.33 or $5,133. This will be taken out of the cash position in my brokerage account. All right. Then I pick an option strike price. All right. And here are the different bid prices for each of those options. Let me show you that quickly. Notice there's a bid and ask for each of these strikes. So I took all the bids because you can sell the options at the bid price. You would buy the option at the ask price. Notice there's a spread here between those two. Schwab, sometimes if you put a limit order a little bit in between, you might get it. But for the purpose of argument's sake, I did selling all the calls at the bid prices, which should execute nearly instantaneously when done. So here are the expiration date, the call option prices. All right, and notice that. So for a $50 call, I'm getting more money per share than for the $52 call, which is just 91 cents a share. I'll talk a little bit about risk reward here again in just a couple minutes. But this is the call option price. This is important to see. All right. Now with Schwab, there's a fee associated with each option contract. One contract represents the right to buy or sell 100 shares. So for one contract, it's 65 cents, which is one of the industry's bests. There's some out there that are as low as 50. Many of them are 75 cents. I like the size of Schwab, and this option fee is a key feature of the strategy that I like to use. So my net proceeds for selling these calls, and let's look at the 52 call, I would sell it at 91 cents per share, which would be $91, but I have to pay my option fee of 65 cents. Well, $91 minus 65 cents is $90.35. But why is it 2 cents less? Well, anytime you sell a security through a brokerage firm, you have to pay the Securities and Exchange Commission a fee, the SEC fee. It's a very small amount. For these amounts, it's 1 or 2 cents. I use 2 cents here for argument's sake. All right. So my total invested is I invested $51.33 for buying 100 shares of GM, but when I sold the call, I got $90.33 back. So really, I've invested $5,042.67 for 100 shares of GM, which I'm willing to give up at $52 a share or $5,200. But remember, I'm selling the stock, so that SEC fee kicks in. Here, it's a greater amount, so the fee's a little bit more. I calculated about 20 cents. So my net profit, if GM goes above $52 by next Friday, of being $157.13. So that's just an example. You can do the same thing for each of the different rows based on a different option price and a different selling price based on the strike price of the option. So let's look at a profit and loss chart using the GM $52 call. Remember that the purchase price is $51.33, the strike's $52, the expiration date is this coming Friday, the option price was 91 cents, the maximum profit's $157.13, so there's the maximum profits, just a little bit over 150. The max loss possible, I could lose $5,042.67 if GM goes bankrupt by next Friday, meaning the stock is worthless. That's probably not going to happen. There's the risk of something astronomical happening to GM, but it's highly doubtful. But here's an important key element. The break-even price for my position is now $50.43. I bought it at $51.33, but my break-even, if I could sell it next Friday after this option expired for $50.43, my brokerage account would have the same amount of money next weekend as it started this weekend with. That's because I captured this option price and the sales price to get me back to the original purchase price. Here, let's look at a couple things. This is the strike price. This would represent my maximum profit. So if the stock went to $52.25 or even higher, I'd still be capped out at $157 worth of profit. I would not make all this additional money, okay, if it went to 55 or something like that. And I have a chart showing that here in a moment. This is my purchase price, and if it ended at the same purchase price, I'd still end up making about $90. And again, I show you the break-even point. If the stock price is just a little bit below $50.50 or $50.43, I break even. Now, if the stock goes down to $49, I could end up losing about $137, okay? But if the stock went down to $49, if I just bought it at $51.33 and did nothing, I'd lose $233. So there's a reason why this helps mitigate the losses, and we'll see that on another table coming up here in a minute. All right, so I wanted to go back to this is the same table I had earlier, but I wanted to show you that the maximum net profit is directly correlated with the call option strike price. The higher the strike price, the more profit I can make. But it's a higher probability or lower risk that GM will finish at $50 or higher versus $53 or higher, okay? So as I increase the strike price, I'm increasing risk for what the price of GM is going to be at expiration next week. Here, that is reflected in the reward. As I increase the strike price or increase the risk, I increase the potential reward associated with this covered call position. So I wanted to get the risk reward kind of illustrated with this chart. All right, so let's look at these different strike prices, 50 through 53, and what is the stock of GM finished next week at these various prices. What would be my position would be. I basically rounded these to whole dollars. There's some cents involved, but for the purposes of understanding, I think the whole dollar concept gives you an understanding. So if GM tanks all the way down to $46, and that will be a pretty substantial move. That's a 10% drop in the stock in a week. That's you know, if I had the 50 call on it, I'd lose $331. If I had the 52 call, I would lose more money, $443. There's the risk reward sort of thing. If I had no call in place, I could end up losing $533 all the way down to 46. All right, so let's look at the 50 call. All right, if I had sold the 50 call, then I would have ended up with a net position of gaining $69 for the week. All right. If I had sold the $50.50 call, I would have made $36. The 51, I would have made $6. But remember, at $50 strike price, if it ended up at 51, not only would I pocket the $6 net, okay, if I sold the stock at 50, okay, but I'd still own the stock at 51. So in reality, I'm actually up even more than that, all right? But at $50, I'd be up $6. It's a little confusing, but we'll see here. Let's take the 52 strike price option line, okay? So notice $52, that means GM actually went up for the week, all right? And the option would have been exercised at 50, 50 and a half, 51, 51 and a half, and $52. Usually if it's right on the strike price, it's a 50-50 chance whether that's going to be exercised or not. I've seen it even with a penny below, if it finished at $51.99, that the option is actually exercised. But not much more than that. All right. So, but if I had written a 52.50 call and it went up to, the stock price went from 51.33, the original starting price, and ended a week at 52, I would have had a profit of $139. And with the 53 call, it would be a little bit less. What's important to see is that the highest position in each of these columns is if just that strike price was hit. So in the $50 strike price, the one with the biggest profit is the 50 strike. It's more than the 50-50 strike and all the other strike prices. If GM finished a week at $50.50, the maximum profit would have been that call. So if you're really, really good at predicting where the price of a stock is at the end of the week, then you just pick the call right at that price or just above it, and you will make the most money possible. All right? And you can see that it follows this diagonal. The 51 strike is best at the 51, 51 and a half is best, 52 is best at the 52, so on and so forth. Now, the highest strike price I show here is $53. But if the stock went to 55, the best thing to have done would have been not to write an option. Because if I did no call, then because it went up so much in a week from 51.33 to 55, that's a $3.67 gain. I would have made $367 without the option. But if I had written a 52 call, I would have made $157. If I'd written a 53 call, I would have made $222. If I'd been really conservative, really risk averse, I would have written a 50 call and still made $69 for the week, even though the stock went all the way up to 55. So this will help clarify the disadvantage when the stock makes a big move up way above your strike price. You may lose the opportunity cost. You're not losing any real money. You made $69 on the 50 call, but you lost the opportunity for making $367. For people that are economists, they understand opportunity costs, but that's okay. It's not an economics class. All right. The next concept I want to go over is finding the premium. The premium is simply the amount that the call is above the stock price. All right. Now, if the stock price was $51.33, like the GM one, and the $51 call, the bid price on that was $1.40. If I sold that call, the premium is the 51.33 minus the in the money strike price, right? Because I would have to sell it at 51. I'd lose the 33 cents, but I get the $1.40, means that I would make about $1.07 per share. All right. So the premium on the 51 call is $1.07. Even though the bid price was $1.40, the premium is $1.07. Let's take the stock price again at 51.33, and I look at the 53 call. The bid price on that was 56 cents. Well, the premium, because this is out of the money, is just simply the call price. It's 56 cents. I don't have, because I would still keep the stock. Okay, if the 53 call was written, if I sold that 53 call, then expiration at 51.33, that option contract would evaporate. So that's why it's 56. All right. Understanding premium is going to be a big part of the rolling calls tutorial, which I hope to get in the next week, 2 weeks, no more than a month from now. And that will be in tutorial number 2. And typically when I roll calls, it's to the next week or to the next month. That's based on the expiration date. I could change strike prices. Often I don't, but we'll roll it to the following week or month. All right, so what are the advantages and disadvantages of this possibility? So, of this strategy, or the covered call strategy. Well, you can make some money even if the stock price goes down. Now, given my history of, I've owned some great losers in time. I owned AOL at the top. I owned Cisco during the dot-com bubble. I owned Enron for a period of time. I was into GoPro in 2016. I have picked some of the biggest losing stocks of all time. And so with that, I've always had my stock choices have not been great. But when I've been able to do these covered calls, and I still can make money if the stock price goes down just a little bit, that has been my saving grace. And it has helped me really make a positive advantage in my overall portfolio performance. By pocketing the sell to open call money, I think you are mitigating the risk by buying the stock essentially at a discount. Because remember, if I was to buy the 100 shares and then sell a covered call, I would get money put back into my brokerage account from after when I bought the shares. So essentially, I've lowered my cost for those 100 shares of stock by writing a covered call contract. To me, this gives me a better chance at making money. The disadvantages are you're tied to the stock until expiration unless you buy the call to close, the call position, meaning you go into the options market and you pay the ask price to get out of the option, and then you can sell your underlying 100 shares of stock prior to expiration. And also I showed you that example with GM, that if the price went from 51.33 all the way up to $55, that you would miss a large increase in stock prices. And that's usually based on a news event. Say Tesla was going to go buy GM. They want all of their plant space, and they wanted to make all of their electric cars in GM plants. That might drive the price of GM stock up a pretty good amount. But, that you could miss large gains. The classic large gain that I missed was I had Amazon at 175 calls. I bought it at 165. I had written 175 calls. And during the week that I had the 175 calls, they announced earnings and immediately jumped to over $200. I did not buy that call to close. I sold my shares at 175 versus $200. I made money, $1,000 per block, but I missed the big increase to 200 if I had just bought and held the stock. This is very different than a Warren Buffett buy and hold a very, very long time period strategy, which a lot of people say is a great way of doing it. It's just that I've had such unfortunate luck in the different stocks I picked. So I'm doing more indices now and better diversification than I've done before. And doing that with this strategy as well, I think has really helped me out. So here are my thoughts. I like covered calls because by collecting that premium, by selling the call, I feel like I'm locking in some profit. Stock could still go down a lot and it could become a loss, but because I've lowered what I originally bought it at by getting some of the money back in the covered call, I think that helps. I'm trying to collect up to 0.5% to 2% a week, and I'm not going to hit any stocks that are going to triple in a week, okay? But I feel like I'm stringing together many singles together to get real gains over time. So I think this is a strategy that works for me, and hopefully if you paper trade this for a while and then look at my weekly calls that I'm going to do on this channel as well, and we'll follow those transactions and we can see pluses and minuses. I'm not sure I'm going to hit every call perfectly every week, so we'll see how I do. You can follow along with that and then possibly set up your own brokerage account. Please remember, this is my opinion only. I am not an investment advisor. I'm not licensed by the SEC. This is an opinion piece. I'm giving you my information. All right. And I do expect tutorial number 2 on rolling calls in the next couple of weeks. It will build upon this. I wanted to keep this at a reasonable length to get you started. And then when you see my weekly transactions that I'm doing in my own personal brokerage account, and then you can take a look at it. Let me conclude with a couple things here. First of all, I'll be doing a weekly stock or 2 of the week and cover calls associated with that. And then each week I'll do kind of at the end of each weekly one, I'll do sort of a report card on how I'm doing and if I closed out positions or if I rolled positions in my covered calls and what my gains and losses are with this, using this strategy. Also, this is a kind of an advanced investment piece. This is for somebody who may have bought and sold stocks with a brokerage account or with a financial tech app like Robinhood in the past. This covered call strategy, most brokerage firms will grant you this strategy for working in the options market because the risk associated with it is a lot less. So Schwab has it as a level 0 approval rating for doing these calls. You can often do this strategy in a Roth account or in an IRA account because the risk associated with it is a lot lower than just buying and selling options on their own. So there's that. Also, this is my first YouTube video, so I'm very interested in comments. And please feel free to let me know how I did in my first video. I also will try to include a link to Schwab. If you were to open an account using my link, I will get a little bit of money from Schwab. So that's part of the reason I keep recommending it, is for my own benefit. I want to be open and transparent about that so that you understand. But I like the platform. I really personally like the platform. It's easy to use. It's intuitive to me for when I do it. All right. So I've talked about covered calls, kind of an advanced investing strategy. If you want some basic investing strategy and basic buying and selling of stocks, let me steer you to Derek Benson. Yes, he's related. He's my son. He's a new MBA. He got his MBA degree last August. And he's put out a series of YouTube videos as well related to personal investing. I think what I'm doing is kind of a next step forward to try and really leverage these cover calls to really help boost your returns. We think differently. We're two generations. So we come at investing from two different angles. But I think his channel is a good one to look at as well. So please like and subscribe to my channel. Please look at Derek's channel and like and subscribe to his channel as well. So this concludes tutorial number 1. Thank you very much for listening. And I will make these better, more colorful coming up in the weeks ahead. Thank you.